Alright, in today's video we're diving into a powerful statement from Ives, who says there are no cracks in AI demand and that monetization is coming. He recently joined CNBC's Power Lunch after a trip overseas to check on the AI boom, and what he found could have major implications for where this market is heading next. First, I'm going to show you the clip of what he said, then I'll break it all down and give you my honest take, and after that, I'll walk you through 3 stocks that Peter Lynch would likely be buying in this environment. Let's hear what Ives had to say.
Your next guest just returned from a 2-week trip to Asia for a check on AI demand. Says he saw more bullish signs for the sector. Joining us, Ives, Global Head of Tech Research at Wedbush. Number one, thanks for coming in because you must be spectacularly jet lagged.
But that's why coffee is great.
Yeah, and hopefully ours here is doing the trick. I'm sure you know people like to give you the business about being too optimistic. Sure. Now, you've been optimistic. You've also been right. I mean, what you've said has occurred. Is there anything that you saw in your extensive Asia trip that tripped you up?
I come away incrementally more bullish.
More bullish?
The reason is that if you look at demand in terms of what you see in Taiwan, relative to all the chip players, all the supply chain, demand's accelerated. I mean, we're not seeing any cracks from an AI build-out perspective, which means from an earnings perspective, that's not just bullish for hardware players, the hyperscalers, the Microsofts, the Googles, the Amazons, and ultimately you talk about the software trade, that's where the ripple effect's going to be. So I just think this is a bright green light going into earnings season, everything we see from a demand perspective, and I think that's the key right now. It comes down to monetization. We come away incrementally more bullish.
I want to combine your world and sort of the world I talk about a lot with energy. Taiwan, South Korea, the places you were, Japan, they're right in the middle of this energy supply shock. Was that discussed at all? I mean, it had to have. When it comes to producing semiconductors and stuff, it takes a lot of power, and they're worried about power right now.
Yeah. So right now, everything like helium being right front and center in terms of through the strait. I mean, there's probably about a 6 to 8 week what I view as really reserve that they have. So the point is that when you think about supply perspective, there is no really concern that there's going to be supply issues over the next few months. Now, look, if this continues, of course, for months, and then that's a whole nother situation. But I think it was calm and much more, I think, not fearful in terms of what we saw from a supply perspective. Demand clearly is what's accelerated. But I think you kind of look at this sort of combo, you felt very comfortable in terms of from a supply perspective. But
they have the helium, they have the raw materials, they have the power they need now, and in, I assume, weeks to come. I'd say because it's going to take a couple weeks to get the new ships to there.
I'd say 3 months. In my view, I think you have a few months until this would be some sort of panic situation. So I'm not going to call it Goldilocks, but I would just say that we're in a situation where I don't think that that's going to be anything in earnings season that you're going to start to see cracks start to form.
Are there any companies you're watching more than any others in this earnings season?
I think it's really, look, software, and me and you've talked about, I think that still is the most disconnected sell-off that I've seen in my career. You're starting to clearly see a huge rebound here, but it comes down to you look at Microsoft, you look at Amazon, Google, the hyperscalers, because when you think about everything that's playing out, hardware is where you've seen the success. Now, the hyperscalers, the software, you start seeing monetization. I think Palantir is going to be one to look at. I think ServiceNow, everything that McDermott's doing, I think that's very important in terms of as a barometer. Because look, it goes back to the Anthropic dark cloud fears over software. It's still there. You need to prove it out. But I think this is, at least for tech, this is, it's a third inning of this game in terms of AI.
Just the third inning.
Top of the third, one out.
Top of the third, one out. I love it. We're going to let you get out and go to bed. I mean, did you not sleep? You just got off a plane from Asia and came straight here? Or?
I mean, I had some time to go home, and get here. But look, but it does speak to the point. You see the demand in Asia. You don't see like a lot of the bears from the 30th floor of the New York City office.
And right off the bat, the tone is clear. Ives just got back from Asia, and instead of coming back cautious or neutral, he's saying he's even more bullish. Not just bullish, incrementally more bullish. That's a strong signal, especially coming from someone who has already been one of the loudest AI bulls over the past couple of years. And here's the key thing he's pointing to. It's not hype, it's demand. When he talks about Taiwan and the broader semiconductor supply chain, what he's really describing is the backbone of AI. This is where the chips are made, where the infrastructure is built, where the real money is being spent. And according to him, demand is not slowing down at all. In fact, it's accelerating. That's a big deal, because if there were cracks anywhere, this is where you would see them first. You would see order slowdowns, you would hear concerns from suppliers, you would start to get whispers about inventory piling up, and he's saying he saw none of that. Now personally, I think this is one of the most important parts of the entire interview, because a lot of people right now are still asking, is AI overhyped? Is this another bubble? And what Ives is basically saying is, look, when you go to the ground level, when you actually talk to the companies building this stuff, the demand is real. This is not just a narrative being pushed by Wall Street, there's actual spending happening, and then he connects the dots in a way that a lot of people miss. He says yes, hardware has been leading, that's obvious, everyone knows about the chip stocks, everyone knows about the massive run in AI infrastructure, but the next phase is software, and this is where it gets interesting, because he specifically calls out companies like Microsoft, Amazon, and Google as the hyperscalers that are going to drive monetization. And this is the part I actually agree with the most. The first wave of AI was all about building it. Chips, data centers, infrastructure, that's where the money flowed first. But the second wave is about making money from it, and that's a completely different game. Because now you need real use cases, you need customers willing to pay, you need products that actually generate revenue, not just excitement. And that's why he keeps emphasizing monetization. That word comes up for a reason. Now the interviewer brings up something that I think a lot of people overlook, which is energy and supply constraints. Because let's be real, AI doesn't run on hype. It runs on electricity, raw materials, and a very complex global supply chain. And they specifically talk about regions like Taiwan, South Korea, and Japan, which are critical to semiconductor production. The concern here is simple. If there are energy shortages or supply disruptions, that could slow everything down. But Ives kind of downplays that risk, at least in the short term. He mentions things like helium supply, which is actually essential for chip manufacturing, and he basically says there's enough buffer, there's enough inventory, there's no immediate panic. He gives it a timeline of a few months before it would even become a real issue. Now personally, I think this is one area where I'd be a little more cautious than he is, not because he's wrong, but because these supply chains are fragile. We've seen how quickly things can change globally. So while things may look stable today, that doesn't mean they stay that way. But for the purpose of this earnings season, his point is clear. Don't expect supply issues to be the thing that derails tech earnings right now. And then we get into what might be the most interesting part of the entire interview. Software. He straight up says that the sell-off in software has been one of the most disconnected moves he's seen in his career. That's a bold statement. And what he's implying is that the market may have mispriced these companies, especially in the context of AI. Because while hardware has been getting all the attention, software is where the long-term value is going to be captured. And he names specific companies here like Palantir and ServiceNow as key names to watch. These are companies that are actually integrating AI into real enterprise workflows, not just talking about it but deploying it. And this ties back to that monetization point again, because eventually investors are going to stop caring about how powerful the technology is and start caring about how much money it makes, and that's where software becomes the scoreboard. Now he also references what he calls the anthropic dark cloud over software, which is basically this fear that AI could disrupt traditional software models. That fear hasn't gone away, and I think that's important, because even though he's bullish, he's still acknowledging that software companies need to prove themselves. They need to show that AI is actually enhancing their business, not replacing it. And then he drops this analogy that kind of sums up his entire view. He says we're in the third inning of the AI game, not the seventh, not the ninth, the third. Top of the third, one out, which basically means, in his view, we're still early. And this is where I think you have to step back and think critically, because if he's right, then a lot of these moves we've already seen might just be the beginning, but if he's wrong, then you're potentially looking at a market that is already priced in a lot of future growth. Personally, I think the truth is probably somewhere in the middle. I do think we're early in terms of real monetization and real-world impact, but at the same time, markets don't wait. They price things ahead of time. So some of that third inning upside might already be partially baked in. Still, the key takeaway from this entire interview is actually pretty simple. Demand is strong, supply is stable for now, and the next phase of AI is going to be all about turning this technology into real revenue. And if that plays out the way Ives is expecting, then the biggest winners going forward may not be the companies building AI, but the ones that figure out how to sell it. Now, let's dive in and break down 3 powerful stocks that someone like Peter Lynch would be quietly buying right now while everyone else is distracted. Let's start with Lululemon Athletica, ticker symbol LULU. Now at first glance you might think this is just a clothing company. That is exactly why this opportunity exists, because Peter Lynch built his entire investing philosophy around finding businesses that are misunderstood, overlooked, or underestimated by the broader market. And Lululemon fits that profile perfectly. This is not just a retailer. This is a brand with pricing power, customer loyalty, and a culture that has turned it into a lifestyle ecosystem. When you walk into a Lululemon store, you are not just buying apparel, you are buying into identity, community, and performance. That matters more than most investors realize, because in retail, brand is everything. And Lululemon has built one of the strongest brands in the premium athletic wear space. Their customers are not price sensitive in the same way traditional retail customers are. They are willing to pay more because they believe in the quality, the design, and the status associated with the brand. That is a moat, and it is not easy to replicate. Now let's go deeper into why this business continues to matter in the long term. First, the global shift toward health, wellness, and active lifestyles is not slowing down. If anything, it is accelerating. People are more focused than ever on fitness, mental health, and overall well-being, and Lululemon sits right at the center of that trend. Second, this company has successfully expanded beyond its original niche. It started with yoga apparel for women, but now it has a growing men's segment, footwear initiatives, and international expansion that is still in early stages. That last point is critical, because when you look at Lululemon's presence globally, there is still massive room for growth. Markets like China and other parts of Asia represent huge opportunities. And unlike many Western brands that struggle to translate internationally, Lululemon has been gaining traction in these markets with strong demand. Now let's talk numbers, because this is where things get even more interesting. Lululemon has consistently delivered strong revenue growth, with double-digit increases driven by both store expansion and e-commerce. Their direct-to-consumer channel is particularly powerful, allowing them to maintain higher margins and stronger control over the customer experience. Margins are another key strength. This company operates with high gross margins compared to traditional apparel companies. That is a direct result of its premium pricing strategy and efficient supply chain. When you combine that with strong brand loyalty, you get a business that can generate significant cash flow, and cash flow is what drives long-term shareholder value. Now here is where I want to give you my honest take. A lot of investors look at Lululemon and think it is already too expensive. They see the valuation and immediately move on. But I think that mindset misses the bigger picture. Because great companies rarely look cheap on the surface. What matters is whether the business can continue to grow into its valuation. And in Lululemon's case, the answer could very well be yes, especially if they continue executing on international expansion and product innovation. Another factor that makes this company stand out is its ability to adapt. Retail is one of the toughest industries in the world. Trends change fast, consumer preferences shift constantly, and yet Lululemon has managed to stay relevant and even lead trends rather than follow them. That is not luck. That is execution. And that is exactly the kind of business Peter Lynch loved. Companies that are simple to understand on the surface, but incredibly powerful underneath. Now let's talk about growth drivers going forward. One of the biggest is the men's category. For years, Lululemon was heavily focused on women's apparel. But the men's segment has been growing rapidly and represents a huge untapped market. If they continue to gain traction here, it could significantly expand their total addressable market. Another driver is digital. E-commerce continues to be a major part of their strategy, and because they have a strong direct relationship with their customers, they can leverage data to personalize experiences, improve retention, and drive repeat purchases. That is a competitive advantage that many traditional retailers simply do not have. And then there is international growth. As I mentioned earlier, this is still in the early innings. If Lululemon can replicate its North American success globally, the upside could be substantial. Now, of course, no investment is without risk. One of the main risks here is competition. The athletic wear space is crowded, and new brands are constantly emerging. However, most of these competitors lack the brand strength and customer loyalty that Lululemon has built over time. Another risk is execution. As the company expands into new categories and markets, there is always the possibility of missteps. But so far, management has shown a strong track record of disciplined growth, and that is something I personally pay a lot of attention to, because at the end of the day, a great business still needs great execution to deliver results. Now here is the bigger picture. Lululemon is not just riding a trend, it is embedded in a long-term shift toward healthier, more active lifestyles. It has a strong brand, high margins, and multiple growth drivers that can sustain its momentum for years to come. And that combination is rare. If you think about how Peter Lynch approached investing, he looked for companies that could grow earnings consistently over time while maintaining a competitive edge. Lululemon checks a lot of those boxes. It is easy to understand, it has strong fundamentals, and it operates in a growing market. That is exactly the kind of business that can compound wealth over the long term. Now, whether or not you believe the stock is fairly valued today is a different conversation, but from a business quality standpoint, it is hard to ignore what Lululemon has built. And in my opinion, this is one of those companies where if you wait for the perfect price, you might end up missing the bigger opportunity. Because the real value is not just in where the stock is today, it is in where the business is going over the next 5 to 10 years. And that is how long-term investors think. So when you step back and look at everything, the brand strength, the growth potential, the financial performance, and the broader market trends, it becomes clear why a stock like Lululemon would be on the radar of someone like Peter Lynch. It is simple but powerful, and sometimes those are the best investments. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Now let's move on to the next company. We're talking about FTAI Aviation Ltd, ticker symbol FTAI. This is the kind of business Peter Lynch would have loved digging into. It is not flashy, it is not constantly trending on social media, and most people do not fully understand how it makes money. But underneath the surface, this is a company sitting in a very strategic position within the global aviation ecosystem. FTAI Aviation operates in a niche that is absolutely critical to the airline industry. They focus on owning, leasing, and maintaining aircraft engines and aviation assets. And if you think about it, engines are the lifeblood of aviation. Planes do not fly without them. Airlines cannot operate without them. And replacing or repairing engines is extremely expensive. That creates a very interesting dynamic. Because instead of airlines constantly buying new engines outright, many of them rely on companies like FTAI to lease engines or provide maintenance solutions. This allows airlines to manage costs more efficiently while keeping their fleets operational, and that is where FTAI comes in. They are not trying to compete with airlines, they are enabling them. That is a powerful position to be in. Now let's talk about why this business matters right now. The global travel industry has been rebounding strongly. Passenger demand has been increasing, international routes are opening up more, and airlines are pushing their fleets harder to meet demand. That means more wear and tear on engines, and more demand for maintenance, repair, and replacement. This is not a short-term trend. Air travel is expected to grow over the long term as global connectivity increases and emerging markets continue to expand. So FTAI is essentially tied to a long-term growth industry, but in a way that is less visible to the average investor, and that is where opportunity often exists. Now here is where the business model gets even more interesting. FTAI focuses heavily on acquiring used engines and then monetizing them through leasing and maintenance programs. This allows them to generate recurring revenue streams while managing costs effectively. It is a capital-intensive business, no question about that, but if managed properly, it can produce strong cash flows, and based on the data, FTAI has been showing solid revenue growth, supported by increasing demand for its services and strategic asset acquisitions. Another key point is margins. Because FTAI operates in a specialized niche with relatively limited competition, it has the ability to maintain attractive margins compared to more commoditized segments of the aviation industry. That gives it a level of pricing power that many people might not expect. Now let me give you my honest take here. This is not the kind of company that most retail investors are comfortable with. It is not simple like a consumer brand. It requires a deeper understanding of the aviation industry, asset management, and leasing structures, and because of that, it often flies under the radar. But that is exactly the type of situation where Peter Lynch found some of his best investments. Companies that are a little more complex, a little less understood, but fundamentally strong. Now let's talk about the growth drivers going forward. One major driver is the continued recovery and expansion of global air travel. As airlines increase capacity and flight frequency, the demand for engine maintenance and leasing solutions will continue to rise. Another driver is supply constraints. New aircraft production has faced delays and bottlenecks in recent years. That means airlines are holding on to older planes longer, which increases the need for maintenance and engine servicing, and that directly benefits FTAI. because instead of replacing engines with new ones, airlines are more likely to repair, refurbish, or lease existing engines. That creates a steady stream of demand. Another important factor is FTAI's strategic focus on high-demand engine types. By concentrating on specific engine models that are widely used, the company can maximize utilization rates and generate consistent revenue from its assets. That is smart capital allocation. And in a business like this, capital allocation is everything. Now, of course, there are risks. This is a cyclical industry. If global travel demand declines due to economic slowdowns or unexpected events, it could impact airline activity and, by extension, demand for FTAI's services. There is also the risk associated with managing a capital-intensive balance sheet. If the company takes on too much debt or misallocates capital, it could affect long-term performance. But so far, the company has been navigating these challenges relatively well, and that is something I pay close attention to, because in asset-heavy businesses, discipline is key. Now here is the bigger picture. FTAI Aviation is not a hype-driven story. It is a business built on real assets, real demand, and real cash flow potential. It operates behind the scenes, but its role is essential, and in many ways, those are the types of companies that can quietly compound value over time without attracting too much attention. That is a very Peter Lynch-style opportunity. Find a business that is overlooked, understand how it makes money, and invest before the broader market catches on. Now, do I think this is a risk-free investment? Of course not. But I do think it is a business that deserves a closer look, especially if you are willing to go beyond the obvious names and dig into less crowded areas of the market. Because sometimes, the best opportunities are not the ones everyone is talking about. They are the ones hiding in plain sight, and FTAI Aviation fits that description very well. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's move on to the final company, and this one operates in a completely different space, but it might be one of the most overlooked long-term compounders on this list. We're talking about Weyerhaeuser Co., ticker symbol WY. At its core, this is one of the largest private owners of timberland in North America, and that alone should make you pause and think. Because land, especially productive land, is one of the most valuable and finite assets in the world. You can print money, you can create digital assets, but you cannot create more land, and Weyerhaeuser owns millions of acres of it. Now here is where the story gets interesting. This company is structured as a real estate investment trust, which means it generates income from its land and is required to return a significant portion of that income back to shareholders in the form of dividends. So right away, you have a business that combines real asset ownership with income generation. That is a powerful combination. But what really makes Weyerhaeuser stand out is how it monetizes its land. This is not just about cutting down trees and selling lumber. It is about managing timber as a renewable resource, harvesting it strategically, and optimizing the value of that land over time. Think about it like this. Trees grow, and as they grow, they become more valuable. That means Weyerhaeuser has a built-in growth mechanism that is literally rooted in nature, and that creates a unique kind of long-term compounding that you do not see in most industries. Now let's talk about why this business matters in today's environment. The housing market, despite its ups and downs, continues to be a major driver of lumber demand. Construction, renovations, and infrastructure projects all rely on wood products. And even beyond housing, there is increasing demand for sustainable building materials. Wood is renewable. It is environmentally friendly compared to many alternatives. And as sustainability becomes a bigger focus globally, timber could play an even more important role. That puts Weyerhaeuser in a very interesting position. Because it is not just a traditional resource company, it is also aligned with long-term environmental trends. Now let's get into some of the financial side. Weyerhaeuser generates revenue from multiple segments, including timberlands, wood products, and real estate development. This diversification helps smooth out earnings over time. When lumber prices are high, the wood products segment performs well. When prices are lower, the company can adjust harvest levels and rely more on other segments. That flexibility is important because commodities can be volatile, but Weyerhaeuser's model allows it to manage that volatility more effectively than a pure commodity producer. Another key point is cash flow. This business generates significant cash flow which supports its dividend payments. For income-focused investors, that is a major attraction. And from a Peter Lynch perspective, this is the kind of company that combines steady income with long-term asset appreciation. Now here is my personal take. I think a lot of investors overlook companies like Weyerhaeuser because they seem boring. There is no hype. There is no cutting-edge technology. There is nothing that grabs attention instantly. But that is often where the opportunity is. Because while everyone is chasing the next big thing, businesses like this are quietly generating cash, managing valuable assets, and compounding over time. And when you zoom out, that is exactly how wealth is built. Not through constant excitement, but through consistency. Now let's talk about growth drivers going forward. One of the biggest is long-term housing demand. Population growth, urbanization, and the need for housing will continue to drive demand for wood products. Even if there are short-term fluctuations, the long-term trend remains intact. Another driver is land value. As Weyerhaeuser continues to manage and develop its land, there is potential for value appreciation beyond just timber production. This includes real estate development opportunities and land sales. That adds another layer of upside. And then there is sustainability. As governments and companies push for greener building materials, timber could see increased demand as a renewable resource. That trend could support higher pricing and stronger long-term demand. Now, of course, there are risks. Lumber prices can be volatile. Economic slowdowns can impact construction activity, and natural factors like weather or wildfires can affect timber production. But these are risks that come with the territory, and Weyerhaeuser has been operating in this space for decades. It understands how to navigate these challenges. Now, when you step back and look at the full picture, this is a company that owns real, tangible assets, generates consistent cash flow, and benefits from long-term structural trends. That is a strong foundation, and it is exactly the kind of business that fits the Peter Lynch style of investing. Simple to understand, easy to overlook, but incredibly powerful over time. Now, when you compare all three companies we discussed today, you start to see a pattern. You have Lululemon Athletica, a premium brand with global growth potential and strong customer loyalty. You have FTAI Aviation Ltd, a behind-the-scenes player in a critical industry with recurring revenue potential. And you have Weyerhaeuser Co., a real asset powerhouse with long-term compounding built into its business model. Different industries, different dynamics, but all sharing one key characteristic. They are businesses that can grow and create value over time. And that is what long-term investing is all about. Now here is the question I want to ask you. Which of these three do you think has the strongest long-term advantage? Is it the brand power and global expansion of Lululemon, the niche dominance and recurring revenue model of FTAI Aviation, or the real asset strength and income generation of Weyerhaeuser? Let me know your thoughts in the comments. I read every single one. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.